Hey, good morning. It's 11:08. I'm Vince Lanci, joining Tom McEntee, for the options show, Option School, or Options TV, T for Tom, V for Vince. Yesterday, we focused by and large on covered call rights. Though they're not the simplest concept to wrap your head around, they are one of the most common trades out there. So to wrap up my little thing there, thanks Tracy very much. To wrap up my little thing there, yesterday we talked about covered calls or buy rights, which is something Tom is very well versed in, and it was also very timely because of the sell-off and the high volatility. And we want to continue with that concept today because we have a rally. We can look at what trades that we proposed yesterday would look like today. The volatility levels are still high, and it's not something you can cover in one session. So let's call this part two of the buy right concept. Does that make sense, Tom?
Yeah, I like that, Vince. I think that's a good idea. I think the buy rights are very important and certainly very very topical in terms of in light of what's going on today versus in light of what's been going on the last couple of weeks in terms of volatility. Yeah, so let's run with that. That's
I like, but before we get into the meat of it, John, I got you. Very good. Get together. Listen, man, you have no idea. My morning shows are way worse than this. I used to do it on my phone. Anyway, thank you, John. Go ahead, Tom. I'm sorry.
Yeah, I think it's I think buy rights are a building block here. Like we talked about butterflies the last week in terms of aiding in one's pricing of options and stuff like that, and where things are. And now we're morphing into buy rights, which are more of a way to defray.
Can we look at one example? I'm really curious about this. I mean, as a spectator, you were all over Johnson and Johnson yesterday. Apparently, there's an asbestos risk out there. Looking at that as a buy right. If you remember what you had or what you were thinking about,
yeah,
can you give us the report on what happened?
Sure.
That would be kind of cool.
That
would be a real life example.
And actually, what I can do is show you the disparity or the difference in volatility between today and a month ago. Well, yesterday, right. I think the stock was maybe half $1 lower. Do you see this up here?
Yeah.
Okay. I think it was 130 and a half, 130.60, something like that, give or take. Okay. We advocated, we spoke, we wanted to keep it, somewhat simple, and we wanted to go 30 days out. So it's a regular way, Jan 18. Regular way, I mean, just quickly, regular way is always the traditional option expiration, the traditional monthly option expiration, third Friday in the month. Okay, so we went regular way Jan. We wanted, at the time, the stock was 130. We were roughly 5% out of the money. So that's roughly 650. We created a synthetic hybrid 137.5 call, okay, by selling, if you do it 10 times, if you bought 1,000 shares of stock at 130.5, I wanted to sell 5 of the 35s, sell 5 of the 40s to create a synthetic 137.5. Okay, and I think at the time you were getting, I'll tell you exactly what you were getting because I can go back and tell you exactly where this thing was. Jan options, 37.5 were $3.20, $1.60. They were $1.80. Yeah, we got $1.90 for the hybrid. Okay, so right now that's roughly we got $1.80 for the hybrid. In other words, we sold these at say $2.50, and these at $1.30. So roughly, add them together, $3.80 divided by 2, you get $1.90. Actually, it's $1.80. Boom, boom, boom. Got $1.80 for the synthetic 137.5 call against buying stock at 130.60 for argument's sake. Okay. Now we're sitting now with the stock's rallied 50 cents. As you can see, it's 131.0 something. And the synthetic call is roughly 243.35, about $1.62. So the synthetic call has come in roughly, I'm going to say 15 cents from where it was yesterday, with the stock up 50 cents. How does that happen? That's incredible. I don't know how it's magical. That is due to volatility contraction in Johnson & Johnson. I'll show down below here as I'm navigating seamlessly through my screen. I will show you here's a screen of Johnny John Vol. over the last 2 months. And we had this up yesterday, Ben, if you remember.
Yeah, I do. I do.
Now, this is traditionally right. This is about a 14, 15. No, I think it's 15. It's 15 is the median implied, 30-day implied for the last 52 weeks.
Right, but what happened from yesterday to today?
Look at this move on Friday, Joe. Vin, right? Boom, bang. It's trading 42 in the fronts. Now, yesterday we were trading it around. This is 12.17. Okay.
Okay.
Now the Jan 21 options were trading at. I can cue on.
And this is a graph of at the money volatility, folks. That's what he's showing over time, how it changes over time. So
Yeah.
Friday it spiked.
Now this is yesterday.
That's
this is
what
January 19 expiration. Okay. This is 12.17. If you can line up on you can see it down below.
So Friday it spiked. Yesterday it peaked, and today it's in. Is that the way to look at this?
Yes, that's exactly right.
Okay.
You can see yesterday when we were advocating buying this thing. Full disclosure, I did not do it. Didn't get it off price.
But let's pretend you did. It's fun. How much has that option come in vol terms?
Okay,
well, we can talk about premium terms, and then we can say, and then we can extrapolate what that option will be worth if Johnson & Johnson doesn't move and vol regresses back to that mean that you pointed out in the 15% area. I think that would be
sure.
very important for people who wanted to buy Johnson & Johnson and wanted to lower their cost basis and wanted to take advantage of high volatility, because that was a home run, what you suggested yesterday. So anyway,
I was just trying to get on base. Go figure.
Exactly.
Funny how that works out. Anyway, so here, Vince and I were talking about it, and we saw
terms. I'm sorry. I just want to ask a couple questions, just to keep it step by step. Before you like just run with it. In vol terms, not that strike itself. How much is the at the money? What's the peak of volatility yesterday?
31. As you can see up here, you see to the right. You can see it at highlight.
My screen's a little smaller. I'm using two screens, and it's my phone. And where is it right now?
About 26 and a half. So say we did 30 in it. It came in roughly 4 clicks.
Okay. Volatility came in 4 percentage points. Okay. If you want to talk about things like volatility came in itself 10%, we're not talking it that way here. We're talking about volatility itself came in 4 percentage points. And those 4 percentage points, depending on the volatility delta or exposure to 1 percentage point change in volatility, decrease the option by, X times 4.
And before you go any further, I'll show you. I can show the viewer the membership.
Yeah.
What you're speaking about. This here, we spoke about this in our class the last couple of weeks. Vega. That's volatility risk per point. Now. Right. The volatility of this hybrid option we created, the 35s and 40s, we would add these two together and get 24/7 divided by 2. 24/7. Isn't that funny?
Now, why did you pick the 35s and 40s? Were you making a 37.5 synthetic call?
Yes. I think we spoke about it because that was kind of the midpoint.
But some people are new. I want them to understand.
Absolutely, you're right. I'm sorry. You're absolutely right. Good point.
When you want to sell a strike, when you want to trade a strike that doesn't exist, you can create a strike by creating an average of the strike. So Tom liked the 37.5 level, but because there wasn't one, he said he's going to synthetically make one by putting a 35 and a 40 together. So we have a 37.5 blended option, so to speak.
Correct. And I think it's also you'll be able to buy 30. There'll be a 37 or a 38 posted in a couple of weeks, so that then you can take it off that way, whatever you want to do. Anyway, and I think Vince really did a good job of covering this last week. Vega volatility, these volatility risk per point. So the volatility risk for this hybrid per point would be, we're adding the two together, you get 24/7 divided by 2. So it's like roughly 12.5, we'll say. Say 1.1, figure 12.5 cents per point in volatility. Okay. So if I sold one option, one of these, sold one of the 35s and one of the 40s yesterday.
Well, let's just say you sold one of just pick a number. You sold, I'm going to type it in. You sold one 37.5 call at, just give me an average price so I can type it in. So you don't have
I think I sold it I thought it was $1.80.
All right. So that's all right. We're cuffing it. 1.80 with at the money vol at, what was it, 30% roughly?
Yeah, roughly 30.
Okay. Boom. Now I put that in there. That's what you did yesterday. So what was the delta of that call yesterday? Do you remember offhand?
Yeah, I think it was rough, about 28, 29.
20. So we'll call it 28 delta, give or take, because that's gonna be something else we can add, like a little bonus thing there. Okay. So now what do we got today?
Well, today, I mean, we bought stock. We sold out at $1.80. That spread is, those calls are roughly, as you can see here, roughly 328. What's that? $6 and 3.25, about $1.60. Okay.
Wait, hold on. I'm sorry. I want to do. There's three components to what this option is made of, right? Where the underlying is,
Correct.
time, which is not going to be important because it's only one day, and volatility. Where is the underlying now versus when you looked at it yesterday? Do you remember?
Yeah, up about a dime.
So the
About
market's
15 cents. Roughly.
so unchanged, right?
Up. Yeah, well, up. Okay, it's up. It's up a little bit. That's fine.
Okay,
Say it's unchanged. That's cool. No problem.
So okay, today JNJ is up 15,
20 cents.
is up 20 cents. And if that was a 28 delta option and volatility were unchanged, it would be up, let's call it a 30 delta option. It would be up 3 cents. Does that make sense? Am I doing that right?
30 delta. It was 30 delta option up 20 cents, about 6 cents. Say a nickel. Call it a nickel.
6 cents. Okay. So without having sheets and without looking at what's going on in the market, we sold roughly a 30 delta option, struck at the 37.5 strike at $1.80. And we would expect it, we're going to round up to a 30 delta option, and we would expect it to be worth 186 minus theta, which we're going to back out. I'm going to back out a tick. We would expect it to be worth 185. And the survey says it's worth what today?
What's that worth? It's worth about $1.62.
Okay. So it was worth 185. Okay. And then the market opened and volatility came in 4%. And now it's worth,
about 165. Call 165.
Right. So the 4 percentage points involved, 3 or 4 percentage points involved, takes it down about 20, 25 points, which far outstrips the increase in value by the delta. The effective delta of that option is negative as the market rallies today, not every day. Think about that. That option's cheaper while the stock is going up. And that's the beauty of selling options when you have a panic situation, especially if you like the stock you're buying. So, I mean, that's just a home run for the play. Anyway.
Yeah, no, that's right. We, on this thing here, current levels, we're up roughly 20 cents in the stock. I say we did 1,000 shares. We've got $200 in the stock, and we got these things are worth about $1.65. So and we're up 15 cents on the option. So we're winning both ways because the volatility has contracted so dramatically. And I would postulate, I mean, it's tough to be long. Look, take it from me. I've been on the wrong side of a lot of moves. Long vol, short vol, whatever it's going to be, usually on the long vol side. This can get painful because after you get, this is kind of binary. I mean, I guess asbestos is bad. I'm not quite sure. This is kind of binary, but if things revert to the mean, this fall, I wouldn't be surprised to see it come into 20 relatively quickly. Because you got to look. I think Vince. I think it's good to put Vince. I got something we can show the viewership.
I know you want to get real advanced, and I want to get. I'm about to ask you advanced questions, like maybe we should collar it, maybe we should roll the call up. But
I want to give you an. I want to show you where Johnson & Johnson vol was 1 month ago, 32 days out.
Right.
Same thing we structured yesterday. 5% out of the money call. All right.
Go ahead.
So I got this down here.
So basically, Tom is going to recreate the 37.5 strike equivalency when volatility was in its normal trading range. To give you an idea how much this option can come in, even if the market doesn't sell off. I think that's what you're getting at, right?
Exactly what I'm getting. Let me see.
So if vol regresses to the mean, this option will be worth.
This is it right here. This is November 19th. Okay, so roughly a month or so ago, I went to now the regular way December options are the 30 or the 32 or the 30-day option. Okay, the stock closed that day, as you can see, 140. Say call it 148. 5% of that is roughly $7.40. We'll put the stock at roughly 155. We'll call it. Look where the 155 calls were trading. with 32 days to go. This is where the 5% out of the money calls we're trading, roughly 28 cents. 28 cents.
Right.
Okay. The 5% out of the money calls today are trading. What we say was $1.65.
Right. Right.
$1.65. Get your head around that one.
So if there's a couple concepts that might not make sense to someone who's trying to factor in volatility and what's going on. Like, for example, why would a call go up in volatility if a market is going down? Second of all, why would volatility come in as the market's going up and volatility blow out on the way down? I don't want to get too much into that specifically, but I just want to say in a generalist point of view, without making it about geek stuff, that just it's a given that in the stock market, volatility of all options in a stock will go up when the market goes down. Now, that means puts go up, right? Puts go up out of the money, puts go up because people are, they tend to panic and buy their insurance at the last minute. As the house is on fire, they're calling, Aetna or whoever. And that happens a lot. Because they don't want to spend money on insurance. So the question people legitimately would ask, or just getting familiar with volatility, is, well, if Johnson & Johnson has this bad news coming out and the stock market's coming off, why would the volatility of calls go up? Like, for example, yesterday, you could see the market, you could see Johnson & Johnson drop 5% and a call that was worth 50 still be worth 50. Because volatility is expanding. And the reason for that, so before Tom goes with the next level in this, is that market makers or volatility traders, people such as myself and Tom, see that puts and calls in volatility terms are the same thing. They're directional tools for sure, but the volatility component can be the only component that you have risk on. So if I were to buy, and I want to do this very briefly so you understand, so it's a little bit clearer why the heck would call volatility be higher in Johnson & Johnson as the market is swooning and there's a potential serious problem here. And the answer for that is properly hedged. A call is a put and a put's a call. But in without using the vernacular, it's kind of like this: everyone goes and buys a put. Then the second guy comes in and says, "Oh, that put's too expensive." And he buys a different put. And the third guy comes in because I'm not going to buy that put. It's too expensive on a relative value basis. I'm going to buy this straddle. Then the next guy comes in and says, "Screw that. I'm going to buy a call, but I'm going to sell stock against it." And before you know it, all the options go up in value. So on bearish news, volatility of calls goes up too. And that gives people like Tom, and I'm not pandering here. Tom does this a lot. People like Tom look for events, whether it be a big sell-off, whether it be an earnings event, to as an opportunity to sell an option that they're comfortable. They know their risk when they do it. For example, this person or this trade that Tom was looking at was for Tom, and I'm going to put myself in Tom's shoes. I'm not speaking for him, but it's kind of like I think we're going to have a bounce, and I think vol's going to come in. So it's kind of a Texas hedge, right, Tom? I mean, you buy stock and you're selling calls. You're betting on the market rallying.
Yeah. I mean,
but just for as a trade, but it's a good trade. It's a good risk reward. He had his stop levels and he had his ideas there. But as an investor who's looking to buy Johnson & Johnson on any bad news, this is a tremendous play for a 2 to 5 year own. You just lowered your cost basis. Anyway, I just wanted to get that out of the way so we can really go into the ridiculous money that can be made selling options, but knowing your risk and what to do after you've made some profits. I just wanted to get that out of the way. So now you can run with it, that they've been fully primed.
Yeah, no, this is Vince makes all excellent points. I just think you want to get your head around the fact that this is where we didn't pick Johnny John out of the sky, right? And I didn't pick the 137 and a halves out of the sky. It didn't come to me in a dream. We picked that this stock had dropped, about 15% in a couple of days, maybe a little bit more. So obviously it's under pressure. Now you got all the buy riders from the 145 level selling 15 vol. They got to do something. They feed it to the fire, so they probably have to cover, right? So that pumps up everything across the board, right? volatility is usually driven by tails. It's like, I'll go up here. I'll show you this, what I'm talking about. Why do I have Twillo up there? Speaking of tails, we're in Johnny John. Okay. I mean, volatility is driven by, you get an event like that, people buy anything, they buy any put they can get their hands on, and just because I've seen it in action. Fear is an incredible motivator, and you buy anything just to get something to stop the bleeding, whatever the heck it is. So you'll pay up for anything. Like I was trying, if you remember in the chat on Thursday, there was something setting up that would have been these puts. As I here, these were the 120 puts, December, that expire this week. Currently about 8 cents. No, we'll call them a dime for argument's sake, right? Now I want to show you the regular way Jan 15 puts. They're about 60 cents. I screwed up. I could have bought that thing. I could have bought the Jans, sold the Decembers, sold the deck 120s, and paid about 15 cents for that thing. That's all. That's worth about 60 cents right now. It's like 3x. Anyway, I'm diverting. I'm digressing. Here, the Johnny John thing. High vol. You want to buy right in high vol. Any of these morons go out and tell you I'm selling condors at 6 volatility and it's just free freaking money. And I'm going to sell a $10. I'm going to sell a $5 put spread and a $5 call spread for 87 cents. God bless them. God bless them. Because you got to know you're risking 9 to make 1, and you want to do that all day. Go right ahead. But that's a freaking dangerous game, man. You got to thread a needle, and all it takes is one hiccup, and that your P&L goes from green to red real quickly. I'm just looking here. I want to sell vol when you want to buy it. I want to sell this thing. We talked. I brought this up. This is. You go back here. I mean, get your head around this. This is what I'm talking. This is a 5% out of the money call in Johnny John a month ago. 28 cents. This is a 5% out of the money call in Johnny John today. $1.60. Right. Huge freaking difference. All right. Everyone's a great, I'm sure, look, we've all seen the mentality. Everyone's a great buy writer in here. You're getting more for these options. Okay. These 5% out of the money calls today than you were getting for an option that was roughly 2% out of the money. And I'll show it to you just so you don't think I'm lying. That was roughly 2% out of the money back in December. Look at the December 150, the stock at 148. Roughly 2% out of the money, they're trading at $1.35. These are 137 and a half, 5% out of the money, trading at $1.60. I mean, This is an enormous spike in volatility. These are historic vol levels in Johnny John. Okay, and that's why. Look, doesn't mean I'm going to be right. Doesn't mean the stock ain't going to trade.
No, but as a trade, it works. So why don't we look at it from 2 points of view and tell people what you would do given 2 different situations. One is you're looking at it as a short-term trade, which would allow you to massage it and do whatever you want to do. We can talk collars and fences and rolling and 3-ways, things like that. But let's start with the easier one. I'm an investor. When you put that trade on yesterday, you were an investor. You're holding Johnson & Johnson for 5 years. You look to hold it for 5 years. What would you do now, if anything? And you want to remain, and as an investor, you do want to remain short a call. Would you move it around? Would you go further out in time? Would you do nothing, maybe? You know what I mean? You're not worried about the downside for this point.
Let me just see if I get this.
Is there would you take profit in that call and roll it to a little higher? Would you roll it away from the stock as it rallies? What do you think?
Well, what I would do here is, I think that what I want to do is I want to see where vol resides in all the different tenors.
Right. So, and I do want to remain long. I'm the investor. Okay, I did the trade on your recommendation yesterday. Let's do it that way. I want to remain long Johnson & Johnson. I do not want it called away from me. However, I definitely don't mind missing out on a couple dollars if Johnson & Johnson gets taken over and goes to $100. You follow me?
Right.
So, I don't mind being short a call as long as I'm stopped out if there's a big explosion higher. So that's basically the concept.
Right. Okay. So, I mean, since the stock is, these options really haven't moved since yesterday. In fact, they've moved lower. Okay. Right. I think we got a couple things working for us here. I mean, perhaps with this thing catches a bid and rallies up to 137, then I'd look to roll it if I get the rally. I think right in here, I would be content in letting it ride and see how it plays out for the next couple of days. I think, like we always spoke, it involves a mean.
So the best move is to do nothing.
Right now,
I don't
nothing.
care if it goes down. You're my broker. I don't care if it goes down. I'm in it for the long haul. I'm just worried about it being called away if it goes up. But at the same time, I think this is a great trade. No, but at the same time, that's my only worry. But at the same time, I'm in love with the concept of collecting premium and creating a dividend. So for the next couple of days, the advice would be do nothing and see if volatility normalizes in the 15% area, maybe.
Yeah, like we discussed. I don't know if it's coming back to 15 really quickly, but certainly, right. I would think 20 could be in the cards. I think the stock could trade back up to 135, 136 relatively quickly, and then I'd look to roll them. You got to look a little here. Vols at historic levels. Now, I don't mind. Looking here, this is, I think, the Febs are in red, as you can see. The apes are in green. I think these are Jones.
And we're not really worried about vol blowing out, actually, too, right? Because if vol's blowing out and volatility goes, up our butt on that option that we're short, that's because the stock is dropping. So it's really not a risk unless we go up quick as opposed to going up slowly. Going down, we don't care, right?
Right. Now, the slow grind higher is the home run scenario for us.
Right. So slow grind higher, we do nothing. All right. The quick move higher is the risk, but we'll worry about that risk later. What about, and remember, I'm not worried about selling the stock. I'm not selling the stock. What if we drop? Would we consider selling another call, or would we, do something different so that we're only short one call, but taking even more premium?
How I would address it now, if we drop precipitously and volatility would approach those 31 levels of yesterday or Friday or something like that, yeah, I'd probably look to roll down, maybe buy the 40. Say we drop down to 125, maybe I'd be consistent with a 5% out of the money call.
Okay. So
40s and
So we would buy. So if the market, if Johnson & Johnson sold off again, I'm not worried as an investor about the risk of the stock. But I do like creating dividends, and it looks like we have a conversation, and Johnson & Johnson could be suppressed for some time. That 37.5 call has done its work. Maybe we can get more premium. So you would say basically we could buy the 37.5 call back and then sell. Let's say the stock is trading, 30.
Yeah. Right. So yes, I mean, what I would say, we'll just keep it simple. Say the stock trades down at 25. 125. I'd buy the 40s back and sell the 30s. Essentially, now I'm creating a 132.5. You follow me?
Yes.
Right. So now I'm short the 30s and 30.5s. I'm sorry, short the 30s and 35s, making it a synthetic 32.5. Now, obviously, you can make it any number you want, depending on the ratio in which you sell the respective options. Obviously, for our purposes, we're just keeping it as simple as possible and zeroing in on 37.5. So yes, I would think in this thing, if I got a precipitous drop, and I think and vol is at very attractive levels for selling, I'd roll down and just sell, be short the 5% out of the money call. Now on the flip side, and I'm glad you brought this up, it's important for everyone out there to realize the stock never gets called away, only unless you let it, only unless you allow it. It never gets called away. You control it. You can buy this. You can always buy those calls back.
Well, what do you mean? What do you mean? What do you mean never gets called away? You mean the stock never gets called away, and if it were to get called away, it wouldn't happen during the month. It would happen at expiration.
Well, the only way if it does get called away, I mean, and you can look. You want to keep the stock. Stock trades to 140. Here we are, Jan expiration 140. Well, why don't we just go 5 bid in the Jan 35s, buy those back or whatever, pay 2.5 at a 37.5 and sell another month.
Right.
The stock never gets called away unless you allow it to get called away. So it's up to you. If you want to remain passive, sure, it will get called away. But if you don't want it to, it will not get called away.
Okay.
So that's important for these guys to understand that. But yeah, so I think you like it. I mean, if you like the stock, it could go higher. Look, by the same token, Vince, if we rally to 137, let's go sell our 142.5. Let's buy these 30s back. Let's buy the 30s back and sell the sell the 40s and 45s. Buy the 37s and back and sell those. Just stay consistent. Stay with that. And then of course, obviously, I know where you're going with this. I think at a certain level, if we're fortunate enough, If the stock is, compliant enough that it does rally, it gets up to 135, 140, 135, 140 level. Then we look to maybe we look to collar it up by buying some out of the money.
But that's the aggressive thing. I want to finish up with the investor thing, because I'm going to tie this to what producers do in commodities right now. Okay, so one of the things that I think that we haven't touched on, but is implicit and is done by investment banks with investors and producers in commodities, is this. If you're long a stock and then you sell a call, covered call writing like we did yesterday, you have a profit. But you're long that stock and you say, I don't think the market's going to go up, but if it goes up a lot, I want to make sure that I participate and don't get run over on a gap higher. And so and this is rare in equities, okay? But I want to bring it up because this is what happens in institutional markets. Okay, so I'm long Johnson and Johnson, right? I wanted to buy Johnson Johnson. I sold a call on Tom's advice, and we made some money. But now I'm thinking. Now I say, for some unreasonable reason, I seem to know something that, you know what, Johnson Johnson is cheap enough now that it's trading under 1x book, hard book, and I think that its negative news is actually going to make it a takeover target. So I think that 37.50 is not a big problem, but it could go to $50, and I want to make sure that I participate in that rally. But I don't want to buy that 37.5 call back. So what an advisor would say is, and they typically don't do this with retail, but I'm explaining it because this is what institutions do. I'm giving you a peek behind the curtain. They'll buy a 45 call. And why would they do that? So they're short the 37.5, 45 call because they want to take in some premium, but at the same time they want exposure if the market goes up. Now, before we get into the more complex stuff, if this were a trade as opposed to investment, I want to give you a real life example of how investment banks advise their clients in trading. And I'm going to give you an example using gold. Okay, all right. Producers mine gold. Producers go to a bank, a bullion dealer, or a commercial bank, and they say, "I need to secure cash flow." And this is where covered call writing comes in, guys. This is what they do to create cash flow. I want to, and my cost of gold is $800. I want to make sure that I have cash flow to run my business. And so the bank, who shall remain nameless, in 1999, advising Ashanti and Cambior, said, because they were being aggressive, gave them a line of credit that they shouldn't have had. But the fun and color part of I'll leave out. Let's just stick with the educational part. So the bank says, we can hedge your production for you. We'll do it for you. We're good guys. We'll give you a free toaster as well. We can hedge your production for you. You mine gold and it costs you $800. Well, gold trading $1,000 right now. We can do one of two things for you, client. We can sell gold futures for you discreetly in the market, and your production is hedged, so long as you have money to cover margin calls if it goes against you. And of course, and the client does. Or, and this is what happens, we can do what's called in the equity world a collar. In commodities, they call it a fence. You also hear it called a risk reversal. But the producer wants to not sell futures because he wants to be able to make money if the stock, in this case, gold, goes up. But at the same time, they need to protect themselves if it goes down. So if it cost them $800 to mine gold all in, then they would buy the 800 put because that allows them to continue running their business. But it costs them money to buy the 800 put. So they'll sell a call. And they'll sell a call with gold trading, say 1,200. They'll sell the 1,500 call. So what they do is they buy the 800 put, which is not what we're talking about. We're talking about covered call writing. But we're going to talk about why the wing call matters. And then they buy the 1,500 call. And the bank says, that's great. I mean, they sell the 1,500 call. That's great. And then gold starts to rally. And the bank that advised the producer, and the producer trades publicly, gold rallies 10%. And this is not about risk. This is about the stock. But the stock does not participate. The stock rallies 5%. Why is that? because the market knows that the stock will not participate in the price of gold above 1,500. The business is hedged, but the upside proxy to gold is not. And then the producer says, hey, our stock is underperforming. And by the way, I'm the CEO, I get paid in stock, and I want this stock to go up. So the bank says, well, you're short the 1,500 call. We're going to buy the 2,000 call. So if gold ever goes to infinity, you're going to be participating again in the market. And voila, you have a client who has protection on the downside, has offset some of their cost on the put by selling the call. That's the covered call. Forget anything about the put side. And then because they want to participate, if the world goes to shit, they buy a wing call. By the way, this strategy doesn't work out. The bank makes money on fees. The bank makes money back to backing. And the producer does not participate on the way up because volatility comes in as we rally. And then we get the $1,600 and they blow out. In 1999, I think the price was $400. Anyway, I wanted to go through that final part. Think about the short call spread as what a producer might do who wants to hedge his production, but at the same time participate if it rallies. But a little bit of a digression, but important because it's a real life example of how options are used by producers. But digression aside, let's talk about the fun part. Yesterday's trade was profitable. Now what are we going to do? We're just going to trade it now.
Yeah, here it is. Yeah, that's.
I'm sorry, I just took us down a rabbit hole.
No, that's fine. That's fine. I'm just trying to think. 343.
So we have choices now, right?
Now as you just in the short time we've been on the phone on the line here doing the webinar, this thing is stocks trading above 131. You see 131 spot 20 for argument's sake. And this call is roughly 243.97 by $1.70. So the stocks rallied roughly another 40 cents. That these things are going up a nickel. So vol continues to contract.
Right. So now our perception right now going forward is this is now a trade we put on yesterday, and it's a trade we're going to manage today. And Tom's going to come up with ideas to manage it, to maximize it, maybe to mitigate some risk based on his own fears. Could be technically based, could be vol based, but it's no longer an investment, and I'm no longer the client. It's just a trade that made money, and we're gonna tweak it a little bit. So I'm listening to you now, sir.
No, absolutely, yeah. So I mean, you want to monitor it. I mean, in a vacuum, you'd be happy to sell this volatility, and that would be one of the biggest mistakes I've typically made during my career. I mean, you're taking the profit too.
But what are the things that you would want to do right now, other than leaving it alone? All right, you bought Johnson & Johnson. You're not married to the stock. You sold volatility. You know it was a Texas hedge, but you were right on both counts. Would you hedge risk? Would you lighten up on stock? Would you buy puts? Would you roll your call higher? Would you double up on calls? I don't know. Like, would you make it a 1x2? What are the type of things that you would consider to let profits run, but at the same time lessen risk? Like I know you like to do things like I've seen you do things where you take profits and use them to finance a free look at a market, kind of like converting a call to a synthetic put. But that's not the situation, obviously.
No, this thing here, I think, Vince, I mean, I'm going to try to remain patient. And look, I mean, yes, I would definitely at some point, you want to, I mean, I think we get to 130. I'm going to look at this thing. It's 131.5. Does it get to 136.5? I don't know. Maybe. If it does, then I'm looking to roll these calls up and then I slap a put on underneath it. Maybe I buy a put at that recent low, the 125.
Okay. It's 11:48. So I'm with you. So you would consider buying a put, right?
If we rallied, I'm looking for a $5 rally in the stock. I think this is so overdone. This is my opinion, and I'm probably wrong.
Right.
But I think it's dramatically overdone on the.
So you think vol? So you continue to think as a trader, right? You continue to think there's more in this. Vol is overbought, and stock is oversold. So you're looking at your risk to the downside, but you're going to wait for the market. You'd like to wait for the market to rally because the put you want to buy is not only going to be cheaper because the market's rallied, but because volatility is going to get slammed.
Absolutely.
Okay.
Absolutely.
Okay.
Absolutely.
See, that's I want to convey that to people. That's the trade. That's an active trader using options. Like like Larry has basically said it. He's like, I don't think Vol's going to participate on the way down. Okay. By the same token, and it hasn't participated as much on the way down. By the same token, yesterday's sell-off, I think, was headline related. I'm not saying it wasn't real. It certainly was real if you close your position. But guys who lay back and like to trade regression to the mean, trading regression to the mean in things like volatility is much better than trading regression to the mean in things like stock, in my opinion, because there's less noise. So, and you have time working for you. So Johnson & Johnson rallies, okay? And maybe that rally won't last long, but the volatility is probably not going to participate as much on the way down. But the idea now is, maybe buy a put, maybe close the call, maybe roll the call higher, maybe not. I don't know, maybe convert the stock to flat. I don't know. Like so now use whatever you do to do stuff. I really want to hear how you do this. So if the market rallies, to what, or volatility comes into what would you look to buy a put? Like whatever it is you use, charts, how far you think volatility will come back. This is your skill set that adds value to the education that I want to hear personally, frankly.
Yeah, sure. Well, here down below, I mean, this is a chart of vol for the last.
I'm sorry, it's like I'm interviewing you now because I really want to know what the hell you're thinking.
So do I. This is a chart of 30-day implies from 1 year for the last 52 weeks, and look at where we are. I mean, the apex around February 9. That bottom that we had yesterday, coincidentally, right? The
Right.
Feb 9 bottom of Friday 24 was at 25.30, 25.30, right? 25.32 SPX. Right in here. Okay, that's where the apex was held for a long time, and then now we just exploded. And it's important. Here's the stock. I mean, the stock was down. Ancient history. What is this? 120. It traded down to these levels, the 120 level, back in right around Memorial Day. You see my cursor, 525.
Yes, I do.
Or somewhere in there. And look where volatility was, 17, and the stock had come off its off a tip up here, 148 in January. It came all the way down to 120 and a vol 17. Stock went from 148 to 127 in about a month. 3 weeks, and vol never got above 21. This yesterday and Friday's sell-off, or shouldn't not screw the sell-off part.
Yesterday
vol
and Friday's
expansion
part was stock specific, not market specific. Is that
absolutely, and it's all news related. Asbestos.
This is the best stuff to sell vol in.
Right.
I'm not advising you to do it nakedly, but certainly.
No, I would never sell it. Look, if you look at you can all these chats are logged. You can look at everything I put in that chat in August and September. I was buying.
But
vol.
I'm totally with you because index vol is lower, but when an individual stock has a problem, it's like 2 tons being put in a 1 ton pickup, and the volatility is going to skate past a reasonable environment, and that's the time to pounce. I'm with you. I'm with you on that.
That's correct. So I'm just saying, just looking at this here, I mean, the stock had a somewhat similar precipitous decline, albeit over 2 weeks and not 2 or 3 days, but the vol never peaked above 21. Here we got as high as it was like 40. The front stuff was in the 40s. 30-day stuff got as high as 31. I mean, this is what we're talking about here. This got ridiculously, I think, overdone because of a news-related sell-off because of asbestos. Because I'm dating myself. Johnny John was involved in Tylenol, right, with the Tylenol tampering.
Yeah, I remember. You're dating yourself. Are you kidding me? Yeah.
So that's what this is. This is an overreaction. That's what I think it's an overreaction to. Pure and simple.
My first trade as a kid was going to the store and buying all the Bufferin and Excedrin off the shelf when Tylenol was pulled. I swear I did that. But
Tylenol was pulled from the shelf. That's correct. So this is a news-related sell-off, pure and simple. I would suspect vol probably comes back into here. These former peaks, this 21 level. Okay.
So it's not unreasonable. It's not unreasonable to look at that big divergence above that last. We'll call it like peak. That move from yesterday and Friday as being almost completely specific to the stock, not to the market itself. So it's not unreasonable to think that however this resolves itself, that volatility will come in to near the top of that. That's a reasonable conjecture.
Yes, I would think that that's a fairly safe assumption. Now, that being said, if hey,
Through buying a put, Tom, you make me want to sell a put spread naked now.
now look what's happened here. Let me. I'll show you this. This is funny. Well, nothing's funny.
Mike's probably going to grab the phone from us because he's got it 12 o'clock. But you got me wanting to sell a put spread now.
Now look what's happened here. Here's our hybrid. Stock's now trading about $1 and change higher than where we could have bought it yesterday. The hybrid's trading at is roughly, think about $3.50, about $1.77. It's unchanged. That hybrid synthetic call we sold yesterday is unchanged. The stock
unchanged the settlement. Unchanged.
Yes, we sold it $1.80. It's currently trading at about $1.80.
Right.
Mid market. Okay,
so
stock's $1.20 higher.
Right. So it was a 28 delta, but its effective behavior in a rally is a 0 delta. Think about that.
It's not participating. In the parlance of many great floor traders, these options are at right now. Right now in Johnny John. That's what you're getting. It was a complete overreaction. Now, what do I do? Look, in a perfect world, we rallied to 136. But look, if we come back in, if I'm right about the volatility move, maybe we come back into 21. Okay, then maybe I'll buy an out of the money put. Maybe I'll buy the 4-click. If this thing were to come in and say 24 vol, I get it. Okay. This is right now is trading roughly 28 volatile. These are the 25 puts. Okay, I'm looking at them because I'm looking for a move to 36, and I'd look to buy 36, 37, 10% out of the money puts. So here's what 10% of the money with the stock at 137 would be roughly 125. Okay, so I'm looking at these 25 puts, 28 volatility. If I'm right, at the money stuff comes in at 21. This might come in at like the 24 level, right? Because of put skew and shit line stuff like that. So if this would come in 4 clicks, if this would have come in 4 clicks right here, the Vega of this option is 11 cents. Comes in 4 clicks. It's 4 times 11.5 cents, or 46 cents, making this thing worth roughly about $1.15 from where we're currently trading at $1.60. That's where I'd look to buy volatility, and I probably specifically key in on this particular strike, and I wind up with a collar, as you were talking about before, long the 25 put, short the 37.5 hybrid, long the stock. Now I've effectively collared the stock and fixed my risk. I stopped myself out at a spot. So that's what I'm looking for. Perfect world. Stock trades to 37-ish in there. Vol contracts dramatically. I buy this put. And then maybe I'd roll up the cost depending upon my outlook. Do I think it gets to 42? I don't know, but I mean, that's what I'd look to do. And if the vol regime was still an attractive one in which to sell, I'd still sell it because I think there are far more attractive ones to buy right now, of which we buy right now, not buy right.
We only have 1 minute left. I think Mike's going to pull us off.
I think our next class will focus on the opposite of this, which would be the synthetic. I think we briefly touched upon it yesterday.
Yeah, I want to ask you an advanced question for people listening at that side. Considering that this is Johnson & Johnson and it's not industry related, it's company related, so far as we know, and you want to sell vol in Johnson & Johnson, but you want to be protected against market moves the way a hedge fund truly will be doing. What would you sell? And right now, even though vols come in, and I know you don't have to, but if you wanted to just sell Johnson & Johnson vol naked and you're playing an advanced play, what vol would you buy against it to hedge yourself against market moves? And by that I mean you're going to sell a Johnson & Johnson straddle or a call or a strangle. I don't care. Are you going to buy an S&P straddle? Are you going to buy an S&P put? Are you going to buy some ETF or competitor vol? You know what I mean?
There, right there, bingo, competitor. I'd buy something else in the industry. I'd buy volatility at a more attractive rate in the industry if I'm worried about market risk as opposed to company risk,
Right.
I'd buy a competitor at a much more attractive, excuse me, at a much more attractive volatility price.
Okay. What would your preference be on options? Like, would you buy puts versus puts? Let's say you're going Johnson and Johnson versus a major competitor. Put to put, straddle to straddle, put to call. Is there any
Well,
preference?
yeah, I mean, I'm just trying to think. I mean, I probably keep it somewhat congruent to what I have here. I mean, I'm essentially short with this buy right here. Effectively, we covered this.
No, but you're going to put a new trade on. You're going to put a new trade. We're going to put a new trade on right now, you and me. We're going to sell something in Johnson and Johnson, and I'm going to ask you, like, what would you want to sell? And forget, we've found the stock that we want to buy. Volley.
Okay. What do you want to do, Amgen? I have no idea. Give me another draw.
No, we don't have to be real about it. I just want to say, it's a competitor with Johnson & Johnson. It could be an ETF. It could be, but I want to talk about option specifics. Would you go straddle to straddle, put to put? I feel like I'd want to sell a Johnson & Johnson 40 delta put, okay, and buy a straddle in the competitor. I don't know. It could be just pushing risk one side to the other. Would it be a put spread, stock to stock, a straddle spread, or a call spread? Assuming that everyone has the same skew formation. Like, how do you play it in equities? I'm asking because I do this in cracks and commodities, but I don't do it in equities.
Yeah, I mean, the put spread thing would be kind of attractive. You're saying the skew presents.
Assuming that there's no other variables different. Well, I think.
Yeah, I wouldn't mind doing something like that. Yeah, I'd buy a put spread and sell a put spread, or I'd buy.
That's the Johnson & Johnson put skew is much higher than its competitors right now. So that's even more of a kicker to do it. I like the trade. I like the idea. Might be something to do.
That's something to look at. Yeah, absolutely. That's I'd look there. I mean, I've done that before. I've done that.
That's why I'm thinking about it. I'm trying to think like you. It's totally the type of thing.
It's not a great place to be, buddy.
Only the Lord knows what goes on inside my head. I hear you. The same can be said for me. But there you have it. I mean, covered call writing as an investment tool, making money on the first day, and as a trade being right on a Texas hedge trade, you look at both risks, and we can come back and talk about it again. We do have to go. It's after 12, and we'd like to again welcome the new subscribers and everyone else except John Hassinger, who's mean to me. But just kidding, John. John's the man, and I'm a big fan of his and Mike Strongen's comments in FX. Start paying attention to FX if you're looking at stocks, because currencies are the stocks for countries. Anyway, have a great day. I'm pretty much done, and I really like to thank Tom for explaining to me the trades that matter, the ways to play equities with covered call rights.
Great being with you, Vince. All right, we'll look forward to speaking to you guys in our next class.